TJM, everybody, and welcome to week 13. We have got tons of stuff to go through, not just because of FOMC events from last week, the market kind of price action as a whole, economic data as well, places like Germany, Australia, but also because it's kind of month end and it's also quarterly kind of end, and there's a lot of moving parts that are kind of going through. So let us just jump kind of straight into it. As always, these are solely views and opinions. These are not trading nor investment kind of recommendations. So quite a lot on last week. By no means is this exhaustive, but just kind of a few things that kind of at least floated to the top of my kind of radar. Let's maybe just work kind of backwards from just an asset class and volatility kind of perspective. So the first clear thing you can see is massive spike on equity vol. VIX going up close to kind of 30%. We are still very kind of low at the 16 kind of 50 levels. So that is very much what do you call it? A mid kind of level, a very low kind of level in essence for equities volatility as a whole. I think once you get past kind of 20, it starts to get a little bit more kind of elevated. But you can also see that the majority of the actual move took place on Friday, and that is actually the case with a lot of kind of the crosses and things that we will see. It's just give me 2 seconds. Is a lot of the moves happened on Friday, which kind of makes it very tough to see how much of this is kind of sustainable versus how much of this is kind of risk off, a knee-jerk kind of reaction. But what you'll note is the equity outperformance of Asia as a whole, pretty much green across the board for the week. We did have some of the futures dipping into kind of the red, but this here is just showing you cash. Europe got the worst of it. And the US, again, not too bad. And again, the majority of these down moves really kind of came through on Friday. It's been a pretty tough week last week to trade, even if you maybe got the views right, as we've been kind of very much whipshawed, especially on the dollar kind of crosses. So vol, big kind of spike up. I do feel though that structurally it's actually hard to stay long kind of volatility. It's not to say that you obviously can't get kind of tactical moves, but you just have to bear in mind you have a Fed and an ECB that basically are pivoting very much back towards being kind of stimulative. But it is causing a little bit of back and forth on the market on kind of maybe concerns around that. Commodities, very much a mixed bag. It is worth noticing that Ole's trade views on cotton and as well as copper paid off quite well. We also had a very big drop in iron ore, close to kind of 10% last week. That could maybe bode for other things that are kind of happening kind of in the space and kind of the sector. Up week for precious metals, but again, those have been quite tough to trade kind of on a consistent kind of basis. FX we'll get to a little bit later, but this doesn't really capture what happens. It was basically a tale of the US dollar being faded into the FOMC, and then kind of a very kind of brutal reversal post kind of that session afterwards. So it was a lot more volatile than maybe is kind of indicated here. And of course, the big mover and closing thing was back end of last week was really on the yen side against all yen crosses and dollar yen moving close to 1.4% lower for the week. Fixed income wise, this is something we've been calling on Macro Monday. It's happening a lot quicker than even I anticipated, but we're now sub 0 basis points on German Bund, so we're negative. Of course, going into more negative territory in JJBs, and as I said, we'd be south of 2.5 on the Fed fund rate on US 10s. And I also said that we'd be breaking the 181, cyclical kind of lows in Aussie from 2016. We broke that this morning. We're about 177 in Aussie 10-year bonds as yields continue to kind of be compressed kind of lower. And really it was all about FOMC kind of last week. If you recall, I was thinking it was going to be a little bit more of kind of a snoozy, but we've gone from, Powell blinking earlier this year and throwing the towel in to him throwing the towel rack and complete kind of bathroom in. That basically completely taken themselves out from any optionality for the rest of the year. It seems now that it's very much the Clarida Fed, who's the vice chair, who's also ex-PIMCO, which, as you know, is one of the biggest bond investors out there. I'm sure that's just a coincidence. And we're basically seeing no more hikes for 2019. We've already seen a balance sheet being flagged coming to an end in SEP. So of course now the obsession with the market is going to be when's that first kind of cut kind of coming through. We've also gotten kind of over the weekend, early doors this morning, the Mueller investigation finally kind of concluded. Basically doesn't say that there's any collusion between Trump nor Trump kind of campaign members and Russia. So you can imagine the field day that the Fox News are going to have in this, as well as also kind of the press. So I'm sure it'll be interesting to see where this kind of escalates to kind of next. But I actually think that this is a positive actually for the market. And then, of course, we had quite a bit of econ data last week. Too much to put here, but it is worth noticing we were flagging the historical kind of miss in Aussie data over the last 2 years in Feb, and that kind of went down beautifully. And I think also there was a phenomenal opportunity to short Oz, as we actually had a move we'll see from the charts where it actually spiked post the numbers. I think some people maybe misread the number to maybe a few people were maybe too short kind of going into it. People were still digesting FOMC, etc. But quite interesting to see. And actually, right now as we're speaking, we've basically gone from small up on S&P futures, NASDAQ kind of 100 futures, maybe call it plus 5 basis points, plus 10, and now we're down close to 50 basis points off of the back of them. And Asia equities obviously lower, ASX 200 down by about 120 kind of basis points. The other thing here that I did not capture was Germany. Friday, very, very poor PMI manufacturing data came through on Germany, huge kind of miss, and that also was a little bit of a cause of the dollar kind of resurgence. So it was more euro weakness story than a US dollar kind of strength kind of story. On the COT side of things, Ola is flagging very little change really on overall kind of dollar positioning, a little bit kind of a scale back, but very interesting moves within. We're seeing a massive reduction in sterling kind of shorts, very much the longs kind of staying the same, kind of around that plus 30K, but it's really, the move has actually been really here, where we're basically now to a 9-month low, with the reduction being kind of 62 kind of percent, which is pretty kind of massive, to be honest, from where we were. And of course, what that means is the positive convexity that I've been arguing for in Jan and Feb and the start of the year is no longer anywhere near as much as it was. So, i.e., going long is at least in the near term, doesn't have you at least a kind of more contrarian kind of view that it was previously. So just something to kind of bear in mind, because obviously, as you know, we've had that long kind of sterling view that played off quite well until I think it was 2 weeks ago when we kind of flagged that it was good to kind of take profits kind of on that. Commodity side, big tick up in actual positioning, almost 51 kind of percent, very kind of broad-based across different kind of sectors, metals, grains, energy kind of side of things. We got to a 3-week high on net long gold, expecting on a dovish FOMC. That should have paid off for the people that were kind of on that kind of trade. And then we also saw some buying, actually, we coming back to the agri space, which has been heavily kind of shorted from that kind of perspective of thing. And then also interesting to see this net long being cut by 41% to a 3-week low on copper, as funnily enough, Ole's level got hit. And to be honest, actually right now copper is holding up a little bit too well in my point of view, hardly kind of unchanged, at least on my readings here on Bloomberg. Going on week ahead, we have quite a few different moving parts. So let's maybe just take econ data and do this kind of backwards. Relatively light for Asia, right, that we actually watch out here. I mean, the key thing is obviously going to be RBNZ. Do watch out for that. Not too much kind of, I think, out of like Australia, given the key news that we kind of got last week. Nothing at least as heavy and punchy as jobs data. We have quite a few things in UK, but obviously it's all about kind of the March 30th Parliament vote. Japan has a whole host of stuff coming through this week from BOJ minutes, Tokyo CPI, jobs data, IP, and there's a lot in the Eurozone, especially in Germany. And again, Germany is that much more important now than any kind of econ data coming out of Europe, just simply given that this massive miss that we had last week. We were expecting 48 on the flash manufacturing PMIs. We got 44.7, if you recall. Sub 50 is contraction, and 47.6 was previous. So it continues to kind of trend lower, which is basically not good for those looking for a turn in kind of Eurozone, as well as some kind of stabilization generally in kind of global growth. China is data light. U.S. has a whole host of stuff, a lot of housing data coming through, current account. We get final reading on GDP, ditto on that in the U.K. We also get personal income and spending for the previous month, as well as PCE there. Core is 1.9. But again, these are a little bit less relevant now, given the huge kind of reversal that we've had in FOMC and kind of the Fed. And we have some sentiment numbers as well as PMI. Worth noticing is a whole bunch of Fed speakers on the docket. There's about 14 here. In fact, Evans is in Hong Kong speaking today and tomorrow, for those of you that may be able to kind of make it over there. Probably, again, most interesting is going to be Clarida, just kind of going forward, maybe even more important than kind of Powell. And of course, what we're looking for is, when maybe the indications for the next kind of rate cut could be, and so on and so forth. Rightfully or wrongly, that's where the market is very much going to be kind of focused on. Key thing will be RBNZ this week. I'm not expecting much, to be honest, from that side of things. And, overall, there's a lot less pressure now for other central banks to be maybe as hawkish or maybe as neutral as they kind of once were, given how the Fed kind of was. So not too opinionated really on any of these. I mean, it'd be interesting to see what happens in Mexico, because obviously, as we know, they were going in line with the Fed, sometimes going double what was kind of going through on there. And I would actually anticipate, if they are looking towards a more dovish tilt, that could actually be quite positive for Mexican assets, which again would be another kind of uplift on the currency. I'm, of course, completely talking the view I had from the beginning of the year, where I think EMFX high yielders will do very, very, very well over the course of kind of the year. So we have this focus really on lower yields, as I said. Bunds back to negative rates. That's going to get a lot of air press and time. We have RBNZ this week. Some of my colleagues flagged me that there's an Apple event tomorrow, so definitely do watch out for that. We were getting a little bit more U.S.-China ripples that were kind of deemed as kind of negative, in the sense of we're getting to the final kind of details, and there seems to be pushback from the Chinese in regards to kind of the final demands, if you will, from the U.S. So again, this is something that I've kept saying is an issue with the date keeping on being kind of pushed back, and surprised that we've not really fully focused on it on the market. And I think at some point that we will do that. However, that has to be measured against the kind of month end and kind of quarterly kind of end. Do we get some kind of window dressing towards the back end of this week? Do we get the dollar kind of bid up? These are some of the things to kind of also be kind of thinking about, and very hard to kind of call one way or another. Worth noting also, Draghi will be speaking as well later on Wednesday. So that's kind of week ahead. A lot of charts to kind of go through with quite a few comments. I wanted to highlight a few things here. So we're going to talk about yen heavily, as well as we're also going to talk about what's happening over in Turkey and the TRY. So these here were basically just moves last week on G10. This is, again, yen crosses, and basically this means that these currencies lost against the yen, and these are in total returns as well, so bear that kind of in mind, even though obviously on a week basis it doesn't make too much of a difference. This one here is against the US dollar. So for instance, the worst performing currency against the yen last week was the loonie, down about 200 basis points. The best performing currency against the US dollar was the yen on the G10, up about 1.42%. So same thing here kind of on Aussie, and same thing here I thought on sterling, given the fact that we are getting towards this March 30th. May be interesting to see how sterling did last week, and you can see it basically lost pretty much against all G10 except for Canada. Oz was a little bit more of a mixed kind of picture in regards to losing against the yen, the Swissy, Kiwi. Obviously, that Aussie Kiwi continued to kind of head down lower, but gained versus the likes of the euro, the NOK, sterling, and the loonie. So this just maybe gives you a little bit of an indication of maybe potential mean reversion plays, as well as if you're expecting more potential kind of risk off, then maybe instead of placing Aussie yen shorts, you may want to be thinking about Kiwi yen shorts, for instance, because they maybe just have not moved as much. So just to give a little bit of an indication of risk on and kind of risk off kind of skews could be useful. Worth flagging on TRY, obviously clear losing against every FX on the G10 space, as well as all the majors on the EMFX kind of space. We had one of the biggest moves on the Tri-Cross. This is the biggest move since the actual 2018 Lira kind of crash, and this was despite some tightening measures from the Central Bank of Turkey, where they basically took out the repos that they were doing on a weekly kind of basis and suspended until kind of further notice. And the big kind of concern seems to be is whether or not they're using the reserves to hold up the currency, i.e. there's elections from a local perspective happening kind of this Sunday, and the market's basically noticing that the CBRT net international reserves fell by over 6 billion, which maybe doesn't sound like too much, but when you consider that it maybe leaves them with only 28, 29 billion, from a percentage perspective, this is huge. The last time that they've officially intervened was not since Jan 2014, and I believe historically they tend to announce on the day. They did then, and then you get kind of the full debrief of it 15 kind of days later. But we've already had CBRT officials, if you recall. It's Erdogan's son-in-law that basically heads the finance ministry and kind of treasury there. So very much a family-run country. And they're basically saying it's nothing unusual. It's business as usual. It's repayments of foreign debt, potential kind of hard currencies to corporates as well. But of course, you can imagine the credibility that they would have. Now, a lot of this is also going through because of the huge inflation domestically, and especially in Turkish lira kind of assets. So there's a lot of locals also divesting at least their lira exposure and looking to kind of hedge themselves in stuff like euro, the USD, gold, etc., and so on. So definitely worth looking into, worth bearing in mind also that there's a launch of a probe into JP Morgan by Turkey, and there's a few other banks that are supposed to also potentially be under investigation. And this was following a piece, I think, where JP Morgan was flagging the concern on these reserves, trying to kind of tabulate the numbers to add up, and was flagging clients to potentially consider kind of shorting the lira. So again, worth really kind of paying attention to. I have not really done too much of a deep dive, nor do I have a view at the moment, but anything that's always overextended is just worth putting on your radar and just kind of following from one perspective or another. So my initial thoughts on this is it's nothing to jump on in the sense of looking to kind of short the Turkish lira. You also have to bear in mind that the interest rate on this is super, super high. So if you're doing any kind of shorting, it better be on a very, very short-term kind of perspective. But I think it's 24% is the official policy rate from Turkey. But it could be interesting for when someone gets a little bit more kind of comfortable and kind of risk on, so a bounce back in EM kind of FX, and maybe something like long try yen then looks a lot more kind of interesting. But I think right now, at least this Monday morning in Asia, it's still looking a little bit more kind of on the dicey side of things. Moving on, we're going to go through now a few charts. This is bond yields. This is US 10s. Remember, I told you it was only a question of time before we get to sub the 250 on the Fed, and we're that. So the question is, do we go back to these 130, 180? Of course, we're going to do so in this kind of cycle. We're still in the tail end of the business cycle. We're not yet even in a recession. But how quickly will that kind of take? Maybe less downward pressure in the U.S., but you have to remember that this is basically like a domino effect. If yields go down in Europe and yields go down in Oz and yields go down in EM, then U.S. yields look that much more kind of attractive, right? So that's just kind of a bit of a domino effect that you have there. This was, I think, the one that's going to be getting the most headlines and airplay. This is Bunds getting back south of 0%. The record here was minus 20 basis points when we kind of had that cyclical kind of low, kind of all kind of mid 2016. This one here is basically Aussie 10 years at 1762, surpassing that kind of 181 kind of levels that we had previously. And then we also have the last one being here on the JJBs, which is here. Currently about -7. We're actually -9 basis points now as we continue to sell off. Will we get back to the minus kind of 30 basis points seen in kind of 2016? And here we got dollar yen. This here's the 4 hourly, and again the 4 hourly here is suggesting that maybe this move lower has been a little bit kind of too drastic. The weekly, as you can imagine, is a bit more of a kind of a question mark. But I was using quite a few 4 hourly charts, just thinking kind of going into kind of the end of this kind of week to mix it up a little bit. But we also kind of step out on some of the other kind of charts. We are sub 110 again, so we're 109.90. This here is CAD yen. If you recall, this maybe is potentially for people who could be looking to kind of play a bit of bounce FX-wise later on this week. Starting to look like we're maybe kind of bottoming out. Big move down over 200 basis points. This here is sterling yen, obviously spicier given the March 30th deadline, but still interesting. MACD kind of crossing up. RSI, this is obviously going to be very kind of event-driven given what happens towards later on kind of this week, and of course also today with another attempt at taking out Theresa May. The Teflon Don. This here's euro dollar. Again, just staggering moves. Really amazing. This is obviously ECB, and back above all of that, and now back kind of here at these kind of 113. Just really, really something. And of course, this is all around kind of FOMC, and this here, I believe, was a German kind of PMI miss that basically kind of happened. So very, very tough as we continue to be kind of in free fall 3 in Germany. Just no end to it. This here is Aussie dollar. Again, just phenomenal shorting opportunity last week. We shook off the housing price numbers. We were still digesting FOMC. The Aussie data came through, very, very abysmal job numbers, but it actually spiked up higher, whether that was because people were focusing on the unemployment rate that kind of came lower, or the positioning was just skewed too much one way. Hard to say, but it was just, kudos to the clients that kind of jumped on this. If you had chats with me, I was kind of saying this was as free as a lunch as you can ever get in the market. And we were about 71.60 for quite a while. And now we are obviously, almost a full figure lower at 70.75. The key level still here to break is 70 cents, and I think once that is broken, then it's an easy run to 68.5, 69. So just kind of food for thought there. And again, on the 4 hourly, it doesn't look like any time it's looking to kind of pop. You can see this 70.75 is the 100 4-hour moving kind of average. Highs we took were about, I think, 71.70 yesterday. Kiwi completely relaxed. No kind of real issue in the Kiwi. No getting spooked or anything. In fact, Kiwi's up 4 basis points this morning versus minus 14 for the Aussie. Here we got Try on the 4 hourly. You can see kind of the significance of kind of the big move up higher. I mean, it's a huge move. This is like 7%, right? Big move, even for an emerging market. FX. It gives you some scope. We'll also look at a longer-term chart. This here is yen Try. Right. Should have actually used the Try yen, but you still kind of get the impression of the magnitude of kind of the move up. Much even bigger than the other one. Then if we kind of step out on a bit of a long-term chart to give you some perspective. So this is dollar Try. This was, of course, the big kind of move. And if you recall, some of you, that we were actually long, as we could already kind of see quite a bit of the turbulence kind of working its way. So we had a long view there, had that kind of huge spike up higher. And this kind of shows you what's kind of going on. So the significance kind of this. And, almost looks like if we start to get towards the 6, we could have another kind of big break up higher. And this is Try yen again on a more long-term kind of chart to give you again an indication of again how drastic this move lower has been. This is Try ZAR, again something a lot of people kind of play given that they're both kind of higher yielding. Again, you get some context of the move kind of lower, right? So this here's the dollar broader base kind of index in EM. So this is a 4-hour chart 4-hourly chart. We look at a weekly one soon. Looks bullish. Looks like we are still going to get some continued U.S. dollar strength versus EMFX on the 4-hourly, so very kind of near term. This one here takes us out to the daily. And what's interesting from this is you can see at least we've had 3 different points where when we get above the 200 day moving average, we have a little bit more of a continuation in this kind of index. So it'll be interesting to see whether that happens now as well, because we did close last week above the 200 a day moving average. And again, you have to bear in mind that this is also now is post super dovish ECB and FOMC, but worth kind of just bearing in mind in that kind of regard. Here we have dollar CNH. Again, this again could be one if you're looking maybe to play kind of risk off. I could see this potentially also moving quite a bit back higher. 76 I think is very doable. Definitely 74. We are actually already ticking up from when we had these slides up. We're about 73 kind of now. I think this is also one of those that it's very hard to kind of hurt you unless we have a miraculous close to the China-US trade deal, which I find kind of hard to believe just given the headlines that we've kind of been getting. This one here is copper. We were trying to bounce this morning. Now we are looking to kind of sell off. I think it's anything north of 285 when the S&P is down 50 basis points is probably like a fade. But the key points here to watch are really 280, 281. That's a big kind of break lower, and 293 to 296 kind of being the kill zone for putting the shorts back on. In my own kind of view, obviously on the 4-hourly, still looking stretched, but not yet really kind of turning around. But great trade from Ole's part. This part here is actually the big level to kind of get back, because this is when we started to get gap higher, which is why if we get below this, we could have maybe another kind of big kind of move lower. This here is VIX, just showing you a bit of significance. That's 4-hourly. This here is a little bit more on the weekly. Actually, it's a daily chart, but gives you more context. So, big move, but still mid-teens, right? Nothing compared to what we've gotten. I would say the only difference is you have to bear in mind we had not yet had a super dovish FOMC and super dovish ECB. I wouldn't even say super dovish FOMC. Like an FOMC here, we were still expecting them to be hiking and at least have 1 or 2 more. Here, they've indicated that they're done, right? Utilities, US ETFs continuing to make all-time new highs, just amazing. And what's even maybe more astonishing is the semiconductor index is getting very close. So we almost did it last week. And this is like something that should be the epitome of cyclical. So astonishing to me that on the back end of the business cycle, that we're making close to all-time new highs again here, but obviously, it's just taken as a kind of tech overlay. So I'd keep this one really in mind, especially for those of you with volatility still being generally quite low, looking maybe to play some quarterly downside kind of exposure. So, kind of mid-April, back end of April, early May, puts on this or puts on some of the single stock kind of semi-names could be maybe kind of interesting if you have a feel that their earnings are not just sustainable. So, and 2 kind of last big charts on sterling, 2 or 3. This is euro sterling. 86 was kind of the big level to kind of get through here. It's been very, very volatile. You can't quite see it here, but year to date, obviously going lower, good for sterling, going higher, bad for sterling. And you could say what you want, but sterling is up year to date against all G10, right? So that price action is telling you something. And yes, I don't think the convexity, at least in the near term, is as positive. I still think structurally the convexity is hugely, hugely positive. I still stand by the view that it's going to be a multi-generational opportunity to be long sterling assets this year, if that point has not already kind of passed. But I can tell you one thing, it was definitely a lot more contrarian in Jan when we were talking about it. I think in a worst case scenario, this is obviously the vote, right? When we started to go up, and then we had that cable move of about 10%. I don't think we could have a similar move back up. I mean, obviously anything's possible, but if that happens, no one can say, "Oh my God, I did not see that coming." So I think again, the downside, whilst potentially big, is not as big as maybe most people kind of think and feel. So for now, I think it's still something to watch. I thought we called it very well early Jan, and you can again make a lot of money without waiting to kind of play for the actual kind of event, right? Ditto really, again, here just on cable, but it's kind of the same kind of idea. This here, again, was the vote, right? So we were well kind of above 140 before it all kind of went down. I think the easiest case, again, is if we have a no deal and hard kind of Brexit, tanks 5, maybe 8%, which obviously means that you can't have your full kind of capital allocated to this because that's obviously massive, right, on a leverage kind of basis. But then it gets a lot easier to kind of get long, right? And then the last one, I believe, should be sterling yen. Again, here showing you kind of the magnitude of the reversal in the move, but still, up on a year-to-date basis after the big kind of pullback in the yen. And of course, we were well above 150 prior to kind of the vote. So with that, let me bring the call to a close, at least from a recording standpoint, and let me